people have to understand that as we get older and as we're taking money out of our portfolio, we have a different mindset than when we're working and we're depositing money every week into our accounts.
How do you stay financially focused when the market seems to have lost stability? We will talk about it today on Financial Focus with John Kuykendall, founder and CEO of GulfCoast Financial Services. GulfCoast Financial has been named Best of the Best in Financial Services 10 straight years and running by the readers of the Lake City Reporter in financial services. And John Kuykendall is here with that perspective to help us keep financially focused. A dose of common sense, which the market does not seem to have much of right now. John, as we are slipping and sliding and things are moving everywhere, and we do seem to have lost our footing in the market, how does one maintain a good perspective and stay financially focused?
Well, Peter, I tell you, it's tough. I mean, a lot of people like to react to the market. And what we've always said here is that it's based on your risk tolerance. The risk tolerance that I like our clients to have is how much risk can we take and still sleep at night. And if they can do that, then we're going to make money. We're not going to make a lot of money, but we're going to continually make money, and we're not going to lose a lot. And so you have to be focused on where your risk is, where your portfolio is, and there are a lot of factors that we have to look at. But the main thing is, Peter, is you just can't overreact to the hype. It's something that is hard for people to do. I've always said that Americans like to be winners, and so we always want to be up. You never want to be down.
Well, I think that's a good point because, John, when financial advisors talk about risk and taking risk, like is that equivalent to losses? Like how much risk can you stomach? Well, I can stomach all the risk in the world when the market's going up, but the moment it starts to go down, like my threshold for losses seems to be quite limited in respect to and perspective of my acceptance of risk when the market's moving upward.
Well, that's it, Peter. I mean, I had a client come in one time and say, okay, I want to buy some stock and I want to make 10% and I don't want to lose anything. And, there's no way that we can do that, Peter.
You found it and everyone lived happily ever after.
If we could time the market like that, there'd be no reason to have us.
Right.
And so people have to understand that as we get older and as we're taking money out of our portfolio, we have a different mindset than when we're working and we're depositing money every week into our accounts. But I've got a paycheck, so I'm not paying myself. So people need to understand that we need to look at what phase of life we're in. And then, like I said, how much risk can you take? Now, I honestly have to tell you that during this whole downturn, I have not had one client call me and ask me what's going on in the marketplace. Now, we do send them updates and we send them, reports on what we think's going on in the market. But they know that we're going to be tactical and we're going to move the money around as we think we have to, not trying to time the market, but trying to eliminate losses and take what the market gives us.
They're not wondering because you're keeping them informed and financially focused, and they know that they've got that financially focused written plan. And I think that helps, like being tactically prepared for volatility before the volatility, being well positioned. John, I think that helps people make it through the volatility with more of a level head and perspective, right?
Well, yeah, Peter, they're comfortable. They have a plan. They know what we're doing. We've told them how we're going to react in good markets and bad markets. They know what we're going to do, and we've done it, and we keep them informed of that. So they have a level of comfort knowing that we're going to take care of them. And so that is a plan that we put together for them. And like I said, every plan's different. Everybody's plan is different based upon their place in life and what their age is and how we need the money. I mean, we have to react. The market's never going to give us completely ups every year, But we've had a really good market for a long time, and people forget, they forget the 70s when we and the 80s when we had a 25% prime. They forget when we had stagflation and we had high inflation, high unemployment, and high prices. Those things are all in the past. But hopefully we've learned from that. We've learned from 2008, and we'll do what we have to do to continue to monitor the portfolios and make adjustments as we have to. But right now, I mean, it's a tough market. We've seen huge reductions in stock prices. The amount of money that these companies, market value that these companies have lost is staggering. But, it will pass and it will be up again at some point. We just have to react, be ready, and react and not overreact. The last thing you can do is make a knee-jerk reaction because you've lost money in the market.
John, I'd like to talk about concentration risk. And no, I'm not talking about my ADD. I'm talking about in the market, how much of the value is concentrated in so few companies. We've heard from the last several years that most of the rise of the value of the S&P, about 80% of the gains, was attributable to just 10 companies. And we've heard them dubbed like the Magnificent Seven, have been the leaders even among that group. Had a meteoric rise over the last several years, but now are the same companies that have led the declines here. Is this eerily reminiscent of the tech bubble bursting? And does concentration risk play out in people's portfolios to cause more risk and more losses than are necessary, or that they are comfortable with, or otherwise would experience?
Sure, Peter. This is just like 2000. We had the tech bubble, the tech stocks, Apple, Amazon, all those stocks were going up. We had Intel, Dell, all those stocks were moving forward. And if you looked at a portfolio, you would see that about 70 or 80% of the portfolio was made up of those stocks. And so when we had the turn down in 2000, those stocks took the hit. And so as they came down, the portfolios came down. So there's nothing changing here. We have seen tremendous rises. People have made a lot of money over this market, but it's attributed to those tech stocks who have contributed magnificently. NVIDIA, Amazon, Google, Apple, all those stocks have increased. And what they've done is a lot of portfolios, a lot of mutual funds, even though you're diversified among a lot of stocks, you have to look at your mutual fund to see how much of that mutual fund is made up of those 7 or 10 stocks. And so this is no different. We weathered that. We will weather this. It's just a matter of time.
And I even heard it was a little bit before my investing time, but during that tech bubble, had somebody been diversified across the different sectors, they wouldn't have suffered near the kind of losses that the overall market and many mutual funds suffered, because they were so highly concentrated in that, at the time, yet unproven .com industry, right? The tech industry. And this is eerily reminiscent because it's tech again, but it seems like this is tech 2.0.25, right? 2025, tech bubble bursting.
Well, that's true, Peter. Back in 2000, because I was there, we were looking at bonds. The bond funds had some great yields. The high risk, high yield bond funds were in the 10%. We had an annuity that paid 10% a year. So there were
And
a lot
nobody
of
wanted it
different.
because they were too low, right, John?
We actually had an annuity that paid 10% a year, and nobody wanted to put any money into it because they wanted to be in the stocks. They wanted to be in tech. And we had tremendous run-ups. There was a fund called the Jacobs Internet Fund that made 94% one year, but it is now gone because it went broke. So, we rise up and we fall based upon the market and what it gives us. And so we have to be segmented. There's always something that will give us a yield. Right now, bonds are doing 4, 5, 6%. So there are ways that we can go into some things and make some changes to our portfolio. Money market accounts are yielding 4.5. There are things that we can do without riding the market all the way down. Now, because the market has taken such a tremendous drop, if you're still in and you haven't made any changes, you've already bled. So you need to be careful and not overreact and go into a money market account and never come out. We've already taken some losses. We might want to see where the market's going and fine tune our portfolio so that we can make it more defensive. But at the same time, we don't want to make it where it can't grow if the market turns around.
Having a personalized, well-diversified portfolio with long-term strategies, having that as part of a plan, John, allows us to remain level-headed and when chaos arrives, identify opportunities, I think a little bit more easily. So if you would, are you seeing that this is a market where we can find some silver linings among the gray clouds and that there are some opportunities that properly positioned folks could or would or should or are taking advantage of?
Well, sure, Peter. It's certainly a great time to take some defensive postures and put some of your money into annuities that have an interest rate that's tied to the market, but we can't lose money, or a fixed annuity which has a decent yield. Like I said before, bond funds are still yielding fairly well right now. Money market accounts, we need to be diversified. We need to look at what we can get in the market without having it tech heavy. This tariff thing that we're going through is in the short run is going to be brutal, because what happens is the market hates uncertainty. And so we are reacting to these tariffs and how they're going to react, how the companies are going to react. We're going to be coming into earnings season shortly. There's going to be a lot of reporting. There's going to be a lot of layoffs. Things aren't settled out yet, so we have to be defensive. Eventually we will weed through this, but we have to kind of take it as it gives us, as it comes, and make the best of what we have. Having done this for 35 years now, I know that there's always something that we can invest in that's going to give us a return while we're waiting for the market to come back. I mean, it may be large value. It may be, like I said, bond funds, high yield bond funds, municipal, whatever. There's something that's going to give us a return, and we can make our portfolios more defensive, but we don't want to take it to the point where we've made it so conservative that we can't keep up with inflation. Now, if you're taking money out of your account because you're in retirement, this is a bad time for you. So what we have to do is we have to be careful in how we're taking the money out. And hopefully everybody's got a large reserve fund that they built up for certain occasions like this, so that we don't have to take money out of the market, but we have a fixed income coming in from other sources, pensions, annuities, and also Social Security. So we need to look at how we're taking the money out of our portfolios and be more reactive right now. Now's not a time to sit back in the corner and say, the world's crashing and nothing I can do. There are things we can do. We need to sit down and work out a plan.
John, you've talked about the compounding effect of the market risk in addition to timing retirement, and how if we've got a large market downturn or in the midst of market volatility, as we are retiring, that is particularly impactful. Sequence risk. So should we adjust our asset allocation as we approach retirement and carefully consider if we're taking too much risk?
Well, that's right, Peter. And that's like what I said in the beginning. The amount of risk we can take is the amount of risk we can sleep with. If I can't sleep at night and I'm constantly worried about my portfolio, then I've taken too much risk. I need to do something to make it more defensive and to make sure that I'm comfortable and that I'm going to be able to have an income. Sequence risk is real. if I retire and I'm taking money out in a down market, my money's gonna go faster than if I retired and took money out in an up market and then had the down market later in my retirement. So we have to be careful how we're pulling money out, how much we're pulling out, and how we're spending our money. Now's not a time, to take that trip around the world and pull the money out or to pay off your house or to do something else because we want to be more conservative. That's not being conservative. That's going to crash your portfolio sooner than we want it to. We need to have a plan, work the plan, know what we're doing, and make sure that, like I said, we have the risk. Now, a lot of people believe that if I subtract my age, from 100, then that's the amount, remainder is the amount of money I need in the market. So if I'm 60 and I take 100, that's 40% in the bond fund, 60% in the market. So we need to, that's one way we can use it. I personally don't believe in that. I think that I would rather be tactical and have an advisor who's watching my portfolio and giving me returns when he can, but limiting the downside by making changes as he sees fit. 3.5 weeks ago, we went into the money market account with all of our tech stocks. So we've already diversified and made the portfolio defensive. Now, do we have a little risk? Yes. But evidently, it's enough risk that our customers can sleep because I haven't had any calls. So it's just a question of the individual investor and what they're comfortable with.
Well, no one wants to suffer losses. Unfortunately, market volatility is a natural part of the investment experience. And considering protection, I know, John, does not mean that you have to relegate yourself to giving up on gains. It really is a matter of how well does your plan have you prepared for the reality that we will continue to see market volatility? And I don't expect for you to have a crystal ball to know the end of this, John, but I don't think this is going to be some short-lived bounce right back up. I think we will potentially see a little prolonged negotiation here, especially as China probably plays hardball a little bit longer and harder than many other places. And I don't know how all of that works out, but I know that everybody's got to have a plan to make their own way through it. And that's exactly what you strive to help each individual personalize and customize for their own situation and comfort level there at GulfCoast Financial Services.
That's what we try to do, Peter. And this isn't going to be a quick thing. We have to weed through this. We don't know how China's going to react. They've already said that they're going to impose higher tariffs on us. We're working through Canada. Canada says they're going to impose tariffs on the wood coming in, or we've imposed tariffs on the wood that we import from Canada, which is going to create higher home prices, higher prices overall. There's a lot of stuff that we're working through, but overall, this is probably something that we should have done a long time ago because our trade deficit is the highest in history. And somewhere we have to have equality, or at least more of an equality than what we've seen with our trading partners in the past.
Well, at GulfCoast Financial Services, they help savers and investors become more prepared and better determine your outcome through the financially focused written retirement plan. And if you would like that financially focused written retirement plan focused on your personal situation and your goals for your financial future, crafting the plan to help you create and achieve those goals, ladies and gentlemen, pick up the phone and give GulfCoast Financial Services, John Kuykendall and the team there, a call at 386-755-9018. 386-755-9018, 386-755-9018, or you can visit online, gulfcoastfinancial.net, gulfcoastfinancial.net. And John, seeing this recent round of market volatility, yet another reminder of why, while quitting is for winners, retirement is not for wimps.
Well, that's right, Peter. That's that new book. We'd be glad to get out to anybody that wants it. But also, don't forget, Peter, we always talk about the 3 buckets. We want to make sure that we have plenty of cash. That's one bucket. We want to make sure that we have predictable, sustainable income coming in to meet our needs. And then the third bucket is the growth bucket. And that's the bucket that we're willing to take some up and down in, but at the same time, it's going to be our growth bucket, but we're not relying on it for our day-to-day living.
Yeah, that is the future money bucket, like distant future, 10 years and more, right, John?
Yep, that's right.
Yep.
That's what it is, Peter. It's for future earnings to keep up with inflation. Inflation's here. It's going to continue to be here, whether it's 2% or 4% or 6%. We're going to have inflation. We have to have a way to combat that as we go through retirement. The one thing that's certain, we're certainly living longer, and we're going to need our money longer. So we just have to make sure that we've got that written retirement plan that we can put into place so that we can sleep tonight and know that our risk is taken care of. And we may lose money, but we're not going to lose enough that it's going to affect our overall plan.
Another perspective piece, John, though, I think is that when investing, keep in mind that investing is about looking forward 5, 10, 15 years in the future, not back at what's happened over the last 3, 5, 6 months. If we look back, we all, have perfect hindsight, right? Hindsight is 2020. We can all look back and say, oh, I wish I would have, or I should have known, but we only deal with the information that we have at the time. We invest money looking for future reward and profit, and that takes time to happen.
That's right. Yeah, it's nothing that we're not investing to make a quick buck. We're investing for the long term. And we do that because we know we've got a written retirement income plan that's going to take care of our day-to-day needs, because we diversified our deposits so that it's not all in one bucket. And that's what we really need to do, is spread out among the 3 buckets, have that cash reserve fund, have that monthly income coming in to cover our need, and then have that growth bucket for emergencies and for keeping up with inflation.
Well, quitting is for winners, but retirement is not for wimps. That's the new book by John Kuykendall. If you would like to pick up a copy or receive one, pick up the phone and give them a call, 386-755-9018, and all the principles described, all the issues that are addressed in the book. If you would like a plan that specifically helps you address them, a personalized strategy, diversified tactics, long-term approach for your personal goals. That's the financially focused written retirement plan, and you can get that at GulfCoast Financial Services by calling 386-755-9018. 386-755-9018. John,
always be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through GulfCoast Financial Services Inc., a registered investment advisor in Florida. GulfCoast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions. GulfCoast Financial Services Inc. has been named as Best of the Best since 2015 in the category of Best Financial Advisor in the Lake City, Florida area. The award was based on receiving the most votes in this category from a survey offered and tabulated by the Lake City Reporter. No direct or indirect compensation was provided to the Lake City Reporter and/or any raters, and the award is not contingent on future direct or indirect compensation offered to the newspaper and/or raters. Portfolio performance is not a criterion, and voting is open to any readers of the newspaper.